Interest Rate Drama by www.forexconspiracyreport.com. The interest rate drama continues as the U.S. Federal Reserve puts off, again, an increase in rates. The rally of the U.S. dollar has been partially driven by the expectation of higher rates. After the Fed announced that it is not raising rates this month, the U.S. dollar fell to its lowest level in a month. Bloomberg Business reports as the dollar falls. The dollar fell the most since the August market meltdown triggered by China's currency devaluation after the Federal Reserve held off on raising interest rates. The U.S. currency reached a 3-week low after the central bank declined to boost its short-term interest rate target, opting to delay an increase amid stubbornly low inflation, an uncertain outlook for global growth, and recent financial market turmoil. The reason for a rate increase would be to forestall inflation. The Fed target is 2% and not higher. However, a slow global economy, low oil prices, and a slowly recovering U.S. economy have kept inflation in check. The Fed appears hesitant to raise rates when it does not have to contribute to an interest rate drama that continues to molest the equity and Forex markets. Interest rates in business. The basic issue with interest rates is that when the cost of borrowing goes up, so does the cost of doing business. The Fed does not want to hurt the U.S. business recovery, so it is holding off on its rate increase. And when it does raise interest rates, the dollar will go up as well. An interesting part of the interest rate drama is the price of oil. So long as the world economy is slow, oil will be excess and the price will remain low. When business picks up, so will demand for oil. The International Business Times looks at U.S. oil prices and the rate hike decision. U.S. oil prices are likely to hover at or slightly above current levels, regardless of whether the Federal Reserve had raised interest rates Thursday or sometime before the end of the year. A rate hike would have sparked short-term volatility in crude markets, but any immediate reaction wouldn't have slammed prices for long, given the shrinking U.S. supply glut and steady global demand, analysts say. During 2015, we're going to continue to be in the $40 to $50 a barrel range for U.S. crude, said Jay Hatfield, president of Infrastructure Capital Advisors, a New York investment company. But we will see a recovery, probably $50 to $70 a barrel in 2016. When oil prices go up, so will the cost of living and inflation. We can certainly expect a rate increase by then, but the rate increase drama will likely come to a head before oil goes too high. When? MarketWatch notes that the Fed forecasts a hike this year. The Federal Reserve on Thursday opted to keep interest rates steady, attributing the lack of a move to global economic and financial developments that, in the central bank's dry language, mean China's economic turmoil and U.S. stock market volatility. The Fed said those developments may restrain economic activity somewhat and are likely to put further downward pressure on inflation in the near term. By a 9-to-1 vote, the Fed kept to its current 0 to 0.25% federal funds rate targeted range. The footnote to this story is that the Fed published a graph that forecasts an interest rate of 0.4% by the end of the year. For more insights and useful information about Forex and Forex markets, visit www.forexconspiracyreport.com.